Cursor just became more valuable than most countries' startup ecosystems. Welcome to Nothing Ventured. I'm Aarish Shah. On my ones this week, whilst half of European venture is packing for Helsinki because Slush starts on Tuesday. And yes, we will get to that. But first, Cursor raised $2.3 billion at a $29.3 billion post-money valuation, a coding assistant now worth more than Stripe was 2 years ago. The investor feeding frenzy. Axel, Thrive, Capital, Andreessen Horowitz, DSC Global, Coatue, Nvidia, and Google all piled into the Series D. That's not just a strong syndicate, that's the core of the global capital stack, all fighting for allocation. And the signal here matters. These aren't tourists chasing a narrative. Marc Andreessen has been in software for 30 years. Nvidia is literally the picks and shovels of the AI boom. Google built half the tooling this ecosystem runs on. They all wrote checks at a $29 billion valuation for a company that's maybe 2 years old. The shared bet is simple. If AI can write and maintain code better than humans, the entire $500 billion software industry gets repriced. GitHub Copilot was a feature Microsoft could bundle. Cursor is being treated as an independent platform, something that can replace Visual Studio Code, replace the traditional IDE, and change how software actually gets built. And the important bit, the defensibility isn't just in the model, it's in the workflow. Once developers bake Cursor into their day-to-day, once their entire dev process assumes AI pair programming, the switching costs are brutal. That's what people are underwriting at $29 billion. But what about the concentration problem? 51% of total venture funding in 2025 has gone to AI startups. In Q3, AI deals made up 23% of all transactions. Half the money, a quarter of the deals. AI companies are pulling in 2 to 3 times more capital per deal than the rest of the market. Cursor just proved that at the top end, there basically isn't a ceiling. So let's zoom out. $29 billion is more than the total venture funding going into Germany this year, more than France, more than the whole Nordic region. One company has raised more than entire national startup ecosystems. And yes, software scales differently to hardware. Developer tools can tap huge markets. But let's not kid ourselves, we are now pricing perfection in. Cursor needs to become a $100 billion plus company to deliver proper VC outcomes at this entry point. How many $100 billion software companies have we actually seen? Microsoft, Oracle, SAP, Salesforce? That's the core list. Now we're adding AI coding assistant to that category and hoping that the public markets agree. So what does this mean for everyone else? If you're out raising a Series A for a B2B SaaS startup right now, you are competing with Cursor for capital. Now, not in a pitch-off sense, different stage, different narrative, but in the heads of LPs and partners. Every dollar that goes into a $2.3 billion round at a $29 billion valuation is a dollar that is not going into the rest of the ecosystem. And the founders who raised at 100 million valuations in 2021, well, they're watching Cursor sprint to $29 billion in 2 years, whilst they're still trying to justify their $100 million round 4 years later. That's the bifurcation. A handful of stories that look like Cursor, and everyone else grinding away in the middle of the distribution. From career suicide to hot sector in 24 months. 3 years ago, if you'd told anyone in venture that defense tech was going to become a hot venture category, they'd probably have laughed. Defense startups were the slide you quietly skipped in LP meetings because it made everybody feel uncomfortable. Now, well, Chaos Industries has just raised $510 million, whilst Forterra has closed $238 million. So what actually changed? Well, defense got a bump in VC podcast sentiment after Republicans swept the US elections, but that is just the surface level story. The real shift starts, not surprisingly, in February 2022. Ukraine showed the world that cheap drones and software-defined warfare can decide modern conflicts. A $500 consumer drone with the right software can take out a $5 million tank. That ratio rewires the incentives. Then there's Taiwan. Xi Jinping is getting older. He has repeatedly and publicly committed to reunification. The Pentagon takes that seriously. Congress takes that seriously. Defense budgets that had been gently drifting down for a decade suddenly reversed and accelerated. And the tech piece is straightforward. The same computer vision that powers Waymo works for autonomous military logistics. The same swarm algorithms used for drone delivery work for coordinated drone strikes. The same satellite imagery processing that you use in agriculture work for battlefield intelligence. The stack transfers cleanly, which means Silicon Valley-style startups can compete with defense primes on technology while still moving at startup cadence. What's the portfolio reality? Look at the portfolios of Andreessen Horowitz, Founders Fund, Lux Capital, and the rest. Every serious fund now has some kind of defense exposure. It's not edge anymore. It's normal portfolio construction. And Dural made it socially acceptable first. Palmer Luckey, ex-Oculus, becomes a poster child for tech meets defense. Suddenly it's cool for top Stanford and MIT grads to build for the military. Then you get Epirus, Shield AI, Saronic, a whole cohort of companies working on hard technical problems in a defense context. The ethics debates did happen, they just moved quickly. Most founders have convinced themselves they're building defensive capability, logistics, intelligence, counter-drone deterrence. Everyone draws their own red lines, but those lines got drawn fast, and then the industry moved on. So what's the uncomfortable question? When these companies exit, and they will because they're raising too much capital to float around privately forever, who's doing the buying? The defense primes, Lockheed Martin, Raytheon, Northrop Grumman, General Dynamics, the people with existing Pentagon relationships, embedded security clearances, and decades of contracting machinery. There is no consumer exit path for autonomous weapon systems. You are not IPOing a company whose core revenue is classified. So any defense tech company raising venture capital today has an implicit exit slide, acquired by a prime. We are, in effect, using venture capital to build the next generation of military-industrial complex infrastructure. That's just the reality. You can like it or hate it, but you don't get to pretend it isn't happening. Why this continues to accelerate? AI and defense are now top-tier topics in VC content and internal strategy decks. That isn't going away. Global tensions keep ratcheting up. US-China competition is hardening. Russia is in active conflict, and the Middle East is volatile. Iran has drones and cyber capability. Every one of those dynamic drives more defense spend. And unlike consumer apps or enterprise SaaS, where you eventually saturate a market, defense spend scales with perceived threat. As long as politicians can point at enemies, budgets will grow. This isn't a blip, this is structural. Defense tech is now a permanent asset class within venture. Expect it on the slide, not as a footnote. Why Europe's diversity play could actually work. Slush kicks off this week, 19th to the 20th of November. Over 13,000 attendees, founders from 70 plus countries, roughly one VC for every two founders. It is a month's worth of meetings crammed into 48 hours. And here's the interesting bit. While the US goes all in on AI foundation models, Europe is building something different. The sector diversity thesis. Slush touches 50 plus sectors: SaaS, health tech, fintech, AI, gaming, deep tech, medtech, energy, edtech, manufacturing, and many more. 85% of global AI funding now flows to US companies. Fine, let's accept that for a second and play out the rest of the chessboard. AI is not the only trillion-dollar story. It might not even be the highest quality one over a 10-year horizon. Climate tech is a multi-trillion-dollar transition. Every building, vehicle, and industrial process has to decarbonize. Europe has real advantages here: policy tailwinds, public support, and deep mechanical and electrical engineering talent. Biotech and healthcare, Europe has world-class universities, national health systems that can actually deploy new technology at scale, and patient populations that are relatively open to trials. Quantum computing, Cambridge is genuinely world-leading. Oxford is right there with it. Quantum might be American on paper, but the intellectual horsepower is global, and Europe holds a decent chunk of it. Advanced manufacturing? Well, Germany has owned that lane for decades. Siemens, Bosch, KUKA. This is where the industrial base lives. When you have to build physical things at scale, European engineering depth suddenly matters a lot. These aren't consolation prizes for losing AI. They are huge markets where Europe has structural advantages. What's the capital efficiency argument? Well, Slush itself is run by students and volunteers as a not-for-profit owned by the Startup Foundation. That bias towards community and efficiency shows up in how a lot of European companies are actually being built. European startups typically raise at 40 to 60% lower valuations than their US equivalents at the same stage. A US Series A might be $50 million at 200 million post. The European equivalent might be 30 million at 100 million post. Run that forward. The US company has to get to $200 million in revenue to justify a 2 billion Series C. The European company might need to hit 100 million to justify a 1 billion Series C. Who's more likely to hit their numbers? The business that needs to 10x their revenue, or the one that needs to 3 to 5x it? Who has more flexibility on unit economics? Who can afford to be disciplined rather than chasing top line at any cost? Cursor raised at $29 billion. To make sense for investors, it needs to be worth $100 billion plus. There are not many companies with that kind of outcome. A European company that raises at $100 million valuation and exits at $500 million can return a fund. That's hard, but it is plausible. Capital efficiency is being treated like a constraint. It's actually the edge. When the cycle turns, and it always turns, the efficient, slightly boring businesses are the ones left standing. Let's talk about the geographic distribution play. Over 80% of Slush attendees come from the Nordics, the UK, the Dash region, France, Benelux, CE, and Southern Europe. Silicon Valley is a single point of failure. If Bay Area costs keep going up, and they are, if talent becomes harder to retain, and it is, if the policy environment shifts, and it might, you've concentrated the entire innovation engine in a couple of zip codes. Europe, by contrast, has Cambridge, Oxford, and Imperial in the UK, ETH, Zurich, and EPFL in Switzerland, TUM in Germany, KU Leuven in Belgium, Delft in the Netherlands, plus the Nordic universities and polytechnics. These are serious institutions producing serious technical talent spread across a continent. And that distribution matters. When talent is spread out, innovation is spread out as well. You're less at the mercy of one region's housing market, one government's immigration policy, one city's cost base. That looks a lot more like anti-fragile infrastructure. Europe has that. The US is clustering harder and harder around the Bay and maybe New York and Boston. That's fragile. The long-term thesis. Well, $60 billion went into US companies in Q3 alone. The US absolutely dominates capital. Nobody is contesting that. But concentration breeds fragility. If 51% of all funding keeps flowing into AI, and that category hits diminishing returns, and it will at some point, the repricing will be violent. We saw the pattern with crypto. We saw it with consumer internet. We'll see a version of it with AI. Europe's diversity is the hedge. A correction in health tech doesn't kill climate tech. A fintech wobble doesn't derail quantum. A manufacturing slowdown does not stop biotech progress. Those sector cycles are not perfectly correlated. That's the point. When one stumbles, capital and talent rotate into another. Slush is the annual gathering of that distributed, diversified ecosystem. The VCs happy to back capital-efficient founders. The team solving real problems in healthcare, energy, and manufacturing rather than building the 47th AI wrapper product. Could that approach beat a hyper-concentration foundation model bet over a decade? Well, we're about to find out. If I had to pick a side, I'd rather hold the diversity trade. The exit window opened for the right companies. The IPO market has finally thawed. Q3 saw 16 venture-backed companies list above $1 billion, with a combined value north of $90 billion. Q2 had 18 companies at a combined $60 billion. 2 quarters in a row, up year on year. The window is open again, but the mix of companies getting through that window really matters. Let's talk about the quality bar. The biggest Q3 IPOs were Chery Automobile, Figma, Klarna, and Netscope. Figma, design collaboration tools used by basically every major tech company. Significant ARR, strong net retention, a credible path to profitability. They turned down Adobe's $20 billion takeout. That tells you everything about how they see their upside. Klarna, a fintech with real transaction volume. Whatever you might think of BNPL, they've processed billions in payments, own direct consumer relationships, and have a business model that actually throws off gross profit. Netscope, cloud security with deep enterprise penetration. If you're protecting data for Fortune 500s, you have sticky revenue, high switching costs, and pricing power baked in. These are not story stocks living off vibes. They are mature businesses with real revenue, visibility on profits, and models that public investors can understand. That's the bar now. If you're not in that league, on numbers and on narrative, you're not going out. Why this actually matters more than funding. The reopening of the IPO windows matters more than any quarterly funding headline, and here's why. Venture has been stuck in a liquidity drought since 2022. Funds sprayed capital in 2020 to 22 at peak valuations. Then exit stops. IPOs disappeared. M&A froze. Nobody could send cash back to LPs. No distributions meant that LPs didn't re-up. Why would they? Their capital is locked in funds that aren't returning anything. If LPs don't re-up, VCs can't raise new funds. No new funds means fewer new investments. The pipeline slowly chokes. $90 billion of IPO value in Q3 means some funds are finally booking real distributions. LPs start to see cash again. And once they have liquidity, they can justify new commitments. New funds then invest into 24 to 26 vintages at sane valuation. That's the flywheel. Exits restart the cycle, and that's finally happening. But what about the M&A picture? Well, M&A reached $27.5 billion in Q3, down from $43.6 billion in Q2, but still very much alive. Between IPOs and M&A, exit markets are functional. Not frothy, not 2021, but functional. Companies can exit, investors can recycle capital, the system moves. And honestly, the ecosystem is built on a steady drumbeat of $200 to $500 million M&A outcomes, more than on the occasional $10 billion IPO. Singles and doubles keep everyone in business. The company's still stuck if you raised in 21 at a $500 million valuation on $10 million of revenue. You needed 10x revenue to justify a $2 to $3 billion next round, and most teams just simply didn't get there. Those companies are in no man's land. They can't raise up. They're terrified of raising down because of the signaling and cap table pain, and they're trying to grow into a number, but growth has normalized. So they wait. Wait for M&A buyers willing to pay 21 prices. They aren't. Wait for markets to fully revert. They won't, at least not to that level. Wait for some macro miracle. The window is open for the real winners. The rest are still parked on the runway. What does this mean for 2026? Well, if IPO markets stay open through 2026, which looks more than likely after back-to-back stronger quarters, we'll see a genuine wave of liquidity events. Funds will chalk up distributions, LPs will feel less trapped, re-ups will get easier. That's when 2026 and 2027 starts to look like a genuinely strong vintage. Not because people overpaid at entry, but because companies raised at reasonable prices in 2024 and 25, whilst everyone else was scared. The best vintage years are always the ones born out of pessimism and discipline. 26 and 27 are lining up to fit that pattern, if the exit window stays open. A third of all capital went to 18 companies. Here's the stat that really captures 2025. A third of all Q3 venture investment went to just 18 companies raising $500 million or more. The three biggest were Anthropic at $13 billion, XAI at $5.3 billion, and Mistral AI at $2 billion. All foundation model plays, all in the same narrative bucket. AI overall pulled in $45 billion, 46% of global funding, with 29% going to Anthropic alone. One company, 29% of the entire quarter's global venture spend. Sit with that for a moment. One company took down 29% of all venture capital deployed worldwide in a quarter. That isn't a market. That's a set of pretty heroic assumptions. What venture capital used to mean. Classic venture capital was portfolio construction. You back 100 companies knowing 90 flop, 8 return some capital, and 2 return the fund. Yes, it's a power law, but there was still diversification by sector, stage, and geography. You spread the risk. Fast forward to now, over 30% of funding each quarter is going into $500 million plus mega rounds. That isn't portfolio construction. That is a handful of monster bets and a very long tail. When Sequoia puts $200 million into Anthropic at a $13 billion round, that's not a let's see what happens see check. That is a binary trade. Anthropic either becomes a $100 billion outcome or it doesn't. There's no soft landing that makes everybody whole. That's hedge fund logic. Crossover fund logic, not the traditional seed to Series B craft. The numbers that show the problem. Q3 venture investment hit $97 billion, up from $70 billion in Q3 2024, 38% year-on-year growth. That looks healthy until you ask where the money actually went. $45 billion went into AI, $13 billion into one company. The top 18 companies grabbed $30 billion plus. That leaves roughly $67 billion for everybody else. Thousands of companies across every other sector, all sharing what's left after the mega rounds. And the trend line is getting steeper. We've had 4 consecutive quarters with global funding above $90 billion. And every quarter, more of that total has been concentrated into mega rounds. More money in the system, less of it reaching the broader market. That isn't a resilient ecosystem. That's a very narrow bet. Let's talk about the geographic layer. $60 billion went to the US companies in Q3, about 2/3 of all capital. The US isn't just ahead, the gap is widening. Within the US, it's the same pattern. The Bay Area takes a majority, New York gets a slice, Boston gets a slice. The rest is crumbs. Asia is subdued, China's VC market remains cautious, Europe is steady but nowhere close to US levels. So you end up with stacked concentration. By sector, AI, by stage, late growth, mega rounds, by geography, US, Bay Area. That's fragility squared. Well, what happens when this breaks? You can't keep shoving 51% of all capital into one sector forever. Markets don't allow it. Eventually, either AI delivers extraordinary returns that justify this, or it doesn't. If foundation models start hitting hard diminishing returns, and the early signals are there as compute spend explodes whilst performance gains flatten, the correction could be vicious. Anthropic at a $13 billion round needs to be worth $100 billion plus. XAI at $150 billion plus valuation has to be north of $900 billion. Those are Google tier outcomes. How many Google tier outcomes do we realistically get in a decade? 1? Maybe 2? Meanwhile, whilst all this capital is being piled onto 18 logos, thousands of solid, boring, important companies can't raise because their category isn't hot. Those companies die. Not because they were bad businesses, but because the funding environment decided they just didn't matter enough. That's what market failure looks like in real time, dressed up as AI optimism. And that's the uncomfortable truth. We should stop pretending that this is classic venture capital. When you are writing $500 million checks into $10 billion plus companies and praying that they go 10x, that is late stage growth. That's crossover. That's hedge funds looking for an illiquidity premium. Venture capital used to be about early stage, messy, uncertain stuff. Portfolio construction, experiments, proper power law returns. Today's mega round game is something else. Different risk profile, different return profile, different behavior. We should call it what it is. Let me pull this together with 5 takeaways from November 2025. 1. Cursor at $29 billion proves AI tooling valuations currently have no obvious ceiling. We are pricing perfection and banking on it. That company needs to get to $100 billion plus for investors to really win. And there are only a handful of software companies in that bracket. 2. Defense tech went from taboo to mainstream in under 2 years. The ethics conversations were short, sharp, and then largely parked. We are now using venture capital to build the next generation of military industrial infrastructure. That's the game on the field. Whether you're comfortable with it is your problem to solve. 3. Slush is a good proxy for Europe's actual edge, sector diversity, capital efficiency, and distributed talent. That may well prove a better long-term strategy than the US's foundation model obsession. Over a 10-year horizon, I'd back diversity over concentration. 4. The IPO window has reopened, but only for real businesses. Figma, Klarna, Netscope, serious revenue, margins, and believable paths to profit. If you're not in that cohort, you're still grounded. But 2 quarters of improving exit activity means that the cycle can actually restart. That matters more than any vanity funding stat. 5. 18 companies taking 1/3 of all Q3 capital is not healthy venture. One of them, Anthropic, took 29% of the entire quarter. That isn't portfolio theory, that is all-in punting. When this corrects, and it will, thousands of good companies will have been wiped out simply because capital never reached them. That is market failure in slow motion. What to watch? Well, Slush kicks off this week. I'll be watching how diverse the real deal flow is. That's where Europe's strategy shows up, not in one-off mega rounds, but in broad cross-sector activity. Q4 will bring more mega rounds. Cursor has set the psychological anchor for $20+ billion valuations in dev tools. A lot of founders and boards are going to be benchmarking themselves off of that. IPOs should continue if public markets don't wobble. The key tell is the quality bar. If we start to see weaker names sneaking out, that's a warning sign that the market is getting ahead of itself again. AI concentration probably gets worse before it gets better. Nobody wants to be the fund that missed the next Cursor. Herd behavior doesn't stop until something very visible breaks. And the final word, at some point, we have to be honest about what this asset class is turning into. It is not, in aggregate, the classic early-stage portfolio-based power law game anymore. A big chunk of it is late-stage growth capital making binary bets on foundation models. It's hedge fund-style risk with an illiquidity wrapper. Those are different games. We should stop pretending that they're the same. See you next month, where I'll be wrapping up the whole of 2025. But until then, I'm Aarish. This is Nothing Ventured. Stay liquid.